Hi, welcome back. In this session, I'd like to talk about alternative investments and alternative investing. You're saying alternative to what? It's a good question, and I hope I have the answers sometime in the next few minutes. So let's start with a couple of very basic facts where I don't think there's any disagreement. The first is much of investing as we know it, books, lessons, classes, have been directed at two classes of investments, publicly traded stocks and publicly traded bonds, with cash as a buffer. Cash being cash invested in something riskless and liquid. But by doing that, we've ignored, and this is the second truth, vast areas of the investing universe. We've ignored private businesses, venture capitalists and private equity investors happen to provide capital there, assets which are not traded, real estate, collectibles, even crypto, and strategies that short stocks rather than go long, because traditional investing has been directed at long only investing, holding stocks or holding bonds, not really shorting, and that's hedge funds. For these alternative investments have been around forever, but for much of their life, especially in the last century, they were accessible only to a very small subset of very wealthy people or a small group of institutional investors. In the last 2 decades, alternative investing has been sold to the mainstream, especially to institutional investors, and now it's coming for individual investors. Without giving too much away, though, the sales pitch for alternatives is very simple. The first part of the sales pitch is based on a very simple portfolio theory maxim, which is adding something that is less correlated with what you hold already, stocks and bonds, can create better risk-return trade-offs, portfolio variation. The second argument is a little more subtle, which is you're more likely to find market mistakes in the alternative investing universe, in real estate and cryptos and private assets. We'll talk about why. And also that the people involved in the space, hedge fund managers, VC investors, tend to be smarter than the rest of us. They can deliver alphas on top of the low correlation. Now that's a pitch. We'll take a deeper look, but let's start with what comprises alternative investments. Let's start with a typical investment class. You walk into the class, you're given the basic structure of how we're supposed to invest, which is you're supposed to allocate your portfolio between publicly traded stocks and publicly traded bonds. How much goes into each will be determined mostly by risk aversion. If you're risk averse, invest more in bonds. If you're less risk averse, more in stocks. But you can bring in market views. If you think stocks are overpriced, you might allocate less to equities than otherwise and more to bonds. But you start with the equity bond mix. Now, of course, cash comes into play because it acts as a buffer. It plays 3 roles. One is it meets your needs for liquidity, which is if you need something in the next month, the next 6 months, you don't want to put it into stocks or bonds where you might not be able to cash out as quickly without giving up something. The second is cash also allows you to adjust the risk aversion component of your portfolio. The less risk you want to take, the more cash you hold. And the third is here again, you can bring in your market timing views. If you feel that both stocks and bonds are overpriced, what do? You hold more cash. That is a standard portfolio allocation. And I have to be quite honest, it's a pretty flexible framework because it allows for different views on markets. If you don't want to time markets, you basically pick an asset allocation mix, 60% stocks, 40% bonds, a classic, and you stick with it. If you're a market timer, you might adjust your allocation to stocks and bonds based on your market timing views. It can bring in different investment philosophies. You're a value investor, the way you pick stocks will be very different than if you're a growth investor. And if you're a passive investor, you can buy ETFs to deliver all of the results within the standard framework. But let's face it, all of the differences across investors in this standard framework will be in the mix of stocks, bonds, and cash you hold and how you pick the individual stocks and bonds to invest in. By doing so, we are ignoring large components of the investing universe. We're ignoring private businesses. Why? Because they're not publicly traded. We're ignoring short selling as a way of changing the return distributions on what you hold. We're ignoring asset classes that are not traded, real estate, cryptos, collectibles. In fact, the best way to see what the choices are in the alternative investing universe is to look at those 3 dimensions, the long-short dimension, the public-private dimension, and the non-traded asset class dimension. Let's start with the long-short divide. Many institutional investors, mutual funds, pension funds, are actually required to be long only. They're not allowed to go short, at least take naked short positions on investments. And maybe that's a good thing. Now, the one institutional investor group that historically, for much of the last century, has been given the power to go short have been hedge funds. In fact, that's what makes them hedge funds. I'm not saying hedge funds have always used this power to deliver returns, but it does allow them to create return distributions that are very different than the return distributions you would have if you're a long-only investor. Now, within the hedge fund universe, there are lots of different strategies, some which are mostly long only, some which include the short component. So even within the hedge fund universe, how much they use the shorting power varies across hedge funds. Now, the last 40 to 50 years, the derivatives markets has created new ways again of positions which break the traditional standard portfolio matrix. Options, futures, forwards, structured products all allow you to create positions that might not move the same way as publicly traded stocks and bonds, and essentially create return portfolios that are different. So the long-short divide has opened up, hedge funds and potentially structured products in a derivatives-based investing. The second divide is the public-private divide. There's the publicly traded market where you take companies, you take them public, and you buy shares in the companies. They essentially raise capital from markets. But there's a big component of the economy that's composed of private businesses. In fact, there are some economies, especially in Asia and Latin America, where the bulk of the economy still is in private hands. These private businesses are, for the most part, funded by their owners, but they too need capital, and when they need equity capital, there are some of these private businesses raise them from outsiders. What am I talking about? If you're a young private business, especially one that wants to grow and perhaps go public at some point in time, it's venture capital that fills the need. Now, within venture capital, you can have venture capital to idea companies, not ideal companies, but idea companies with angel financing, to growth capital for young businesses. For more established private businesses where the owners either want to cash out or use capital to augment their businesses, private equity steps into the mix. Venture capital and private equity. And increasingly, private investors have banded together to also provide credit, the private credit market, where instead of going to a bank to borrow money, private businesses can go to these private credit investors who set the terms and negotiate rates and presumably bring better ways of assessing default risk into the mix. That's the public-private divide: venture capital, private equity, private credit. There's also the reality that there are asset classes that are lightly traded or not traded at all. For the bulk of the 20th century, real estate was not traded on public markets. It was held by local investors who were invested primarily in real estate with localized knowledge. That started to change in the 1970s with real estate investment trusts, but REITs comprise a very small percentage of overall real estate. The 1980s with Lurinieri and the mortgage-backed security boom, another chunk of real estate also got securitized, but notwithstanding the securitization of real estate, it is still true that real estate punches well below its weight. In other words, if you took a pie chart that looked at real estate value in its true form as a portion of the economy and then compared it to real estate as a percentage of public markets, real estate in public markets is well below what it should be. Oh, there's a whole other arena of assets which are not traded, primarily collectibles. And there's a range here. You can start with gold, right, which investors have held off and on as a way of, especially when they lose faith in fiat currencies or as a way of insuring against inflation. You can have fine art or not so fine art, ranging from paintings from the Middle Ages to, non-fungible tokens or NFTs, which are digital art. And finally, at the risk of raising the ire of some more true believers, you can argue that cryptos belong in the space as well. Bitcoin and, adding that, to your mix could presumably bring in something that you don't have in a standard investing universe. So you can see alternative investing stretches the spectrum from, hedge funds to private equity to venture capital to private credit to these non-traded to real estate, cryptos, collectibles. And those are what the alternative investing space cover. Now, sales pitch for alternatives, the basic sales pitch is a very simple one. It comes out of the first investments class you take, which is if you can combine two investments which are not perfectly correlated with each other. then the combined investment can create magic. Magic in what sense? It can create a portfolio that has less risk than each of the individual investments. And the lower the correlation, the greater the payoff to combining the two from a diversification standpoint. That's the first big sales pitch for alternatives, is they're less correlated with stocks and bonds. So adding them to a portfolio comprised entirely, almost entirely of stocks and bonds can create better risk-return trade-offs. The second is a little more subtle, which is the alternative investment space is illiquid, it's opaque. That's a disadvantage, but it also means that market mistakes, if they happen in that universe, are more difficult to spot, more difficult to exploit. And if you have somebody with superior skills in those areas, they might be able to find and exploit those mistakes and deliver extra returns, excess returns, or alphas in investing terminology. So it's a combination of low correlation and alpha that's pushed alternative investment into institutional investing mix. So let's take the correlation argument. This is just one example of a correlation matrix. You can find 100 other examples online of different asset classes. And remember, any number below 1, there is an advantage to adding. So if you take the S&P 500, which is publicly traded stocks, and you look across, you can see the correlation is well below 1 for some of the asset classes. And adding them to a stock-based portfolio should give you diversification benefits. So that's a correlation argument. We'll come back and look at the weak links in that argument, but it does look like there are asset classes that are lightly correlated with publicly traded stocks and bonds. And the payoff when you add an asset class that is lightly correlated with your asset class is you create better trade-offs. This is actually one example of what a sales pitch would look like for alternatives. So if you look at the 3 pies to the bottom, they're comprised of the standard mix of stocks, bonds, and cash. And what this graph looks at is what happens when you add alternatives to the mix. In each case, when you add alternatives to the mix, you create higher returns and better Sharpe ratios. Sharpe ratios look at the return you get as a function of the standard deviation of your portfolio. The higher that number, the better the trade-off you're getting. So in each of these cases, adding alternatives delivers a higher return for any given level of risk. That's a pretty strong sales pitch, right? So that's the first part. The alpha argument is a tougher one because now you're arguing that these investors are not just bringing in less correlated investments, they're more likely to also deliver returns more than they should, given that they can find market mistakes and exploit them. And again, there is at least an intellectual argument for why this might be possible. If you take real estate, you take collectibles, if you have a market mistake, it's much more difficult to spot, much more difficult to exploit. So it's more likely you're going to find market mistakes there. And at least until recently, the perception was that some of these alternative asset managers, especially VCs and private equity investors, were smarter than the rest of us. They had the localized knowledge and the intellectual capacity to find and exploit these mistakes. That's the alpha argument. And again, on the surface, there is some basis for it. This is a graph of returns for different alternative asset classes, the dispersion within each one. So you take, let's take venture capital early stage. The median return of a early stage venture capital is about 13%. This was during a period where the S&P 500 delivered about 10%. That's pretty good, right? They're earning more than the S&P 500. First, we're not adjusting for risk, but there's a second component here that's worth watching. Look at that dispersion. The difference between the worst early stage VCs and the best is a wide one. So there's lots of dispersion, much more so than in public markets. But there's another aspect of alternative investing that might make it attractive to institutional investors. Unlike the public markets, where if you looked at mutual funds and you see dispersion, and you see winners and losers in a period, the winners have no staying power. In other words, the winners in one year are not the winners in the next year. In the alternative investing space, especially in the VC and the PE business, winners seem to sustain themselves. They stay on as winners. So if you can latch on to a winner, you might be able to get those higher returns that they're earning. We'll see again the catch in this argument, but you can see the alpha argument. So with that low correlation and alpha behind them, the people pushing alternatives were able to make some leeway with institutional investors. Take pension funds, for instance. If you look at their holdings by asset class in 2001, almost 90% plus was in stocks, bonds, and cash, traditional standard portfolio. Less than 10% was in what we would call alternative investing. Now, And then you go to 2010, you can see that stocks and bonds are still dominant, but the alternative investing class is now bumped up to 15, 16%. You go to 2020, it's about 20, 25, 26%. You get to 2022, you're pushing into 30%. Clearly, the alternative investing pitch has worked enough that many pension funds have moved their money from stocks and bonds into these alternative investments. And it's not just pension funds. You see the same thing with foundations, with insurance, and family capital. It's gone crazy. 52% of the money is in alternative investing. So clearly the sales pitch has worked in getting institutional investors to buy in. Now, with all that said, though, you should also note that many of the early adopters of alternative investments are celebrated. Most famous case is David Swensen, who ran the Yale Endowment Fund for 30 plus years and who steered the fund, you can see it in this graph, towards alternative investments starting in the 1990s, well before other institutional investors were. And it paid off for Yale, big time. David Swensen became a role model for endowment fund managers at other universities. So the sales pitch worked, institutional investors bought in, and individual investors saying, we would like some of that too. But before individual investors get too excited, here's something that we need to look at. At least on the surface, all this alternative investing seems to have paid off. In what way? Cambridge Associates, which reports data for venture capital and private equity. So there's a vested interest that they have in making them look good in terms of return, what they do for other investors. And looked at funds over time, endowment funds over time, and then they found that endowment funds that allocate more than 20-30% of their money to alternative investments did much better on a Sharpe ratio basis. So you remember, the higher the Sharpe ratio, the better the return you're getting for a unit risk than investments that invested less. Sales pitch worked, and at least it seemed to be working in this graph. But now let's bring in the other side. In a 2022 paper, I think it was 2022 in CFA magazine, the author looked at funds and which added one element of alternative investing, hedge funds on. So these are traditional pension funds that added hedge funds on to their portfolio to look to see whether the Sharpe ratio promise actually gets delivered in practice. So in this study, for instance, you can start with the 60-40 traditional portfolio, no alternatives, Sharpe ratio 0.68. And then it added different hedge funds to this mix. And it looked at the correlation of these hedge funds, and the correlation is low, 0.34, stretching down to 0.02. You're adding something that's very lightly correlated, right? At least if you believe portfolio theory, that should lead to much higher Sharpe ratios. What this study found instead was almost no change in the Sharpe ratios. You're not seeing the promise pay off in practice. They also looked at another sales pitch for alternatives, which is, you add alternatives to your portfolio. In really bad years, you won't do as badly as somebody who's got their money entirely in stocks and bonds. They looked at maximum drawdowns, what happens in bad years. And what they discovered was that during bad years, adding hedge funds, which are lightly correlated, did not make bad years less worse. In fact, they looked just as bad. So both in terms of Sharpe ratios and drawdowns, you're not seeing the payoff from alternative investing. And there are a few who basically believe that this entire buy into alternative investing has been a mistake. One of those is Richard Ennis, who's been very vehement about arguing that alternative investing has actually brought down returns. So this is at least for a large chunk of institutional investors. I do think he goes a little overboard in saying no institutional investors should adopt alternatives. But his argument is, if you look at adding alternative investing, often you end up with worse risk-return trade-offs than otherwise. So now the question is why? Given the correlations I showed you, and given those alphas you saw by looking at the returns that these alternative investors make on their own, you're saying, why isn't it showing up in practice? Where's the beef? The bottom line, I think, is that even long-term beneficiaries of alternative investing seem to become more skeptical about its benefits over time. That 2018 paper, the three authors, Fradzikis, Ryan, and Markov, looked at adjusting even the Ivy League endowments for risk properly, and they discovered that when you do that correctly, That benefit you saw in Sharpe ratios disappears. But perhaps the most telling sign that the heyday of alternative investing might have crested was last week Yale announced that it planned to get rid of a big chunk of its private equity investments because they were not pulling their weight, delivering returns. So what's going on? Why are we not seeing the returns in practice? I think there are three reasons. One is that the correlations you saw in that matrix, historical correlations, are either understated or misleading. Understated in what sense? When you invest in publicly traded stocks and bonds, you get market prices every day. When you invest in private equity or venture capital, these are non-traded assets. They're appraised rather than actual market prices. In theory, they're supposed to be marked to market, but in practice, we know that there's a lag there between when the pricing change happens and when they get marked to market. That lag might result in the correlation you see. So in fact, the true correlation might be 0.95, but with the lag, it looks like 0.75. And during market crisis, which is really the only time you care about being diversified, right? I mean, it's the 2008s and the 2020s. During those crises, it turns out that even lightly correlated alternative investments start to behave like stocks and bonds, in which case you lose the benefits from spreading your money across alternative investments. So that's the first thing. The understated correlation in that during market crisis, the correlations start to get closer to 1. The second is something that every alternative investing salesperson tells you up front, often in the interest of being clear about the downside. They say, look, alternative investments are not liquid and they're opaque, and you should be okay with that. And the way you should be okay with that is if you're an institutional investor with a long time horizon, then you should be able to live with these less liquid investments. And many institutional investors often up front say they don't care about liquidity that much. They have long time horizons. Well, it turns out that how much we care about liquidity is not stationary over time, that our need for liquidity goes up during crises. So even investors who claim not to care about liquidity upfront often care about liquidity, especially during periods of crisis. And secondly, that illiquidity also shows up as transactions costs, higher bid-ask spreads, higher price impact that drain from your returns. The other aspect of private investments in the alternative investment space is they're opaque. Opaque in what sense? You invest in a hedge fund, you're not going to get a chance to look into the insides of that hedge fund. Invest in a private equity investor, you may have no access to the individual investors that private equity investments that the private equity investor makes. They're opaque and they're not transparent. Again, in good times, you don't care. If you're getting 18% returns, you don't want to look under the hood to see why it was 18 and not 18.2%. You know when you care? During a crisis. So illiquidity and opacity might not be issues much of the time, but when they become issues is when you really care about them, is during crisis. The third factor is those alphas you saw, and for a long time they were touted for hedge funds. It was the perception was venture capitalists and private equity investors beat the market. That perception is starting to fade, and we're going to see this in the evidence. And for three reasons, some of which I've talked about before. First is the PE and the VC business have become much, much, much bigger. Trillions of dollars, thousands of funds. And as they become bigger, they've attracted average and below average investors in the mix, kind of dragging down the quality, dragging down those returns, at least in the aggregate. The second is the investment game itself has become more difficult to win. It's become a flatter investment world. The data, the computational models, the edges used to beat the market have kind of gone away. And the third is, as ETFs and passive investment vehicles enter the mix, if you're a successful hedge fund, those ETFs manage to copy you, and within a few weeks or a few months or very quickly, you start to see your excess returns fade away. The alphas are disappearing, and it's starting to show in the numbers. This is a graph of alphas for hedge funds, the composite hedge fund alpha. The way to look at this is any number above the line means you're delivering a positive alpha, more excess returns. And you can look from 94 through 2008, you can see the excess returns. The graph here is the cumulative excess return. So basically, you'd have made a lot of money between 94 and 2007 in hedge funds. Starting in 2007, you can see the fading in alphas. In fact, in the last decade, the average hedge fund starts to look a lot like the average mutual fund, underperforming a passive investing vehicle. Hedge fund alpha seems to have gone away. Now, again, we can debate, they can look at subsamples and perhaps draw different, but it's undeniable that hedge fund alphas have decreased, if not gone away completely. With private equity, there's a simple test you can look at. In this graph, I look at public equity investors versus private equity investors. You can see between 93 and 2007, there's the private equity investors beating public equity investors by a lot. Since 2007, the game's evened out. Again, we can debate whether there's some alpha left, but it's clearly a lot less than it used to be. So those three factors are playing in, and there's a fourth factor that's always been there that we need to face up to. Alternative investments are more expensive than investing in publicly traded companies. And as an investor in these alternative vehicles, you get what's left over after those costs. Take the classic 2 and 20, where a private equity investor or a hedge fund takes 2% of your funds and of the funds under management every year as a fee, then collects 20% of returns over a benchmark. Now, it's true, both those numbers have come under some pressure. The 2% is now down to 1.37%. The 20% is down to 16.4%, but that's still a lot of money to leave on the table. Investing is a tough enough game to win out without adding this burden on top of yourself. Maybe even if alternative investing delivers all the benefits that it does, I would seriously doubt that the benefits are large enough to cover a 2 and 20 fee on a consistent basis. So am I trying to talk you out of investing in alternatives? Not at all. Not at all. In fact, I think alternative investments belong in all our portfolios, individual as well as institutional. But here are my suggestions. First, be picky about alternatives. Forget the alpha pitch. I think it's gone. Focus on the correlation pitch. You want to add on alternative investment classes that are less correlated with public markets. What does that mean? Private equity and venture capital become a lot less attractive because to me they're extensions of public markets. Some hedge funds, I think especially ones with strategies that cut against public equity returns, may be worth adding on. Gold, collectibles. If you're going to make an argument for Bitcoin, this has to be it. Up till now, Bitcoin has behaved a lot like risky stock. Maybe it'll stop doing that. But be picky about the alternatives. Pick low correlation alternatives. But that low correlation is not coming from, pricing lags. Second, avoid high cost vehicles. 2 and 20, no question. That shouldn't even belong. In fact, any institutional investor my pension fund manager who adds a hedge fund and pays 2 and 20 deserves to be fired. You cannot beat that cost over time, no matter how great a hedge fund manager is. And if your alternative investing strategy is so complicated, neither the seller nor the buyer understands what's being talked about, better to avoid it in the first place. 3, be realistic about time horizon and liquidity needs. If you ask investors, do you have a long time horizon? The answer you always get is, yes, of course. But remember, as an individual, that time horizon is often not in your control. If you're impatient, you're subject to panic attacks and to peer group pressure, you have a much shorter time horizon than you're letting on. If you're an institutional investor, I really don't care what your time horizon is. I care about your client time horizon because that's what determines what your time horizon is. And finally, as you saw, most of the sales pitch for alternatives comes from historical correlation matrices and historical alphas. And if nothing else, I hope you take out of this session is how much you should distrust them. The historical correlations might be artificial because of the way in which private assets get And the historical alphas might reflect that the fact that hedge funds over the last 20 years have delivered more than they should, but that much of that is dissipated over the last 4 or 5 or 6 years. So if you're going to add alternatives, be selective about it, avoid high cost vehicles, recognize if you have a shorter time horizon, you should invest less in them, and be wary about driving this entirely on historical data. I hope you found this session useful, and I thank you very much for listening.